We've been saying this for some time. Banks are raising rates. It's not that the banks are not raising rates in different buckets depending on which segment they want to catch. Banks are also coming out with innovation. I also mentioned sectors which we are focusing on: trust, societies, hospitals, all of these. Then there is this entire base of the pyramid segment, which possibly apart from Jan Dhan we haven't really focused on. So again, that is something we are focusing on to see that even those small value, small ticket deposits, can we get some of those? And I think the FM also is on record to say that you have to actually go out and market. It's no longer enough for us to try to get it digitally, which is important, but and to think about walk-ins. So we have to go out and actually seek deposits, which we are doing. We have now outbound teams for liabilities. Earlier we used to have assets teams, marketing assets, but now we have liability marketing teams. So all of these things are being done. The other thing, of course, is that as the market corrects over some time, everything which goes up will ultimately correct. I think some of that money which used to be with us will also come back. So it's going to be a mix of things.
Is there scope to raise rates further? What is the scope?
We are already raising rates now. Every 1 or 2 months you see every bank raising some rate or the other. If the market demands, we have to raise rates.
So what about MFI loans? Are you seeing any
One second,
potential?
are you done? So
Just one question.
Yeah.
On your dais, you said that because deposit growth is not happening, RBI has also hiked risk weights, project finance loans. So is this an indirect sort of step that they are taking, that don't do this riskier segment anymore?
No. So I think please don't misquote me. The simple fact is deposit growth is lagging advances growth. It's not that deposit growth is not happening. It's lagging. So there's a gap. Now how do you fill that gap? You have to either raise, like I mentioned, infrastructure bonds, AT1 bonds, all of that. And at the same time you raise deposit rates as well. So if that gap persists, then that creates imbalances. That's what the regulator is pointing out. That there are imbalances, that's not good for the industry, for the bank, etc. And because otherwise some banks also go into bulk deposits. Now, bulk is again inherently unstable. It's only a function of interest rates and it can go away very quickly. So therefore retail deposits, which is far more stable, is the way to go. That's what the regulator is telling us. On the segments where risk weights have been raised, project finance which has not yet finalized, I think the message is that these are risky segments. It is unconnected to whether your deposits are funding it or not. These are risky segments. So if they grow very fast, how do you control that risk? That is the whole idea.
So what potential?
It's not into deposits, huh?
So what potential risks are you seeing in the MFI loan space? RBI has mentioned that in its latest policy also. So are you planning to increase rates on?
No. So for us, MFI is a regular segment for us. Actually, more than MFI, what we do more is self-help groups, because we do direct lending to self-help groups.
Delinquencies seem to be rising in the segment.
Maybe in some areas, not for us. We don't see that in our portfolio. Not in our portfolio. So I am not talking on behalf of others. There are others who have much more exposure to MFIs. We don't have that much. Our exposure is direct. So it's like self-help groups, as I mentioned, other joint liability groups. So we do more of direct agriculture lending, not so much of through intermediaries. So in that sense, we are not seeing much delinquency.
SMAs are fine in this particular segment.
So sorry?
SMAs are fine.
SMAs, and we don't see too much delinquencies in our segment. Other players may be seeing, I can't comment for that.
And what is
Has the scope and demand, you mentioned 81 bonds, has that improved after SBI is the MF investment?
So this has just come and it will help in the valuation, which was under some difficulty
Has
there.
that opened up the market for you?
I can't say, it's too early actually, just about 10 days. So
And would raising funds through infrastructure bonds actually help your CD ratio?
it's helping already. Let's see, we are getting liabilities from that segment, long-term liabilities. So in that sense, it's akin to a resource, like a deposit. So it helps in that. We are able to lend more.
So there is constant, CD. Banks are like raising CDs right now. Would the regulator be comfortable with that? Because is there any signal from the regulator that there is too much
No.
reliance on CD?
Because there's some amount of overcrowding happening.
So we haven't heard so far, and I can't speak for the regulator what they're going to say. But anything which shows a growth which is much faster than sustainable and stable, I think the regulator is right to talk about those things. But we haven't heard anything on CDS for early days.
So what is your view on ULI, the RBI yesterday?
Too early to say. We don't know the details. I think it would be, if it works out like the UPI which the governor talked about, that would be a fantastic thing. I think for small value credit. The larger value probably has to be a one-to-one
They're
thing.
trying to position it like UPI, but UPI was more B2C. It worked because it was more consumer facing, whereas ULI they're trying to focus on more MSME and agri segment.
Yes, so I fully don't know the details of ULI. I would not like to comment till I know the full details.
What's the volume of CBDCs you're seeing right now?
Not much. It's still it can go up much, but much more than what it is today.
What can be done to increase the volume in CBDC, sir? It's
What can be done?
suboptimal right now.
So we have to all work together on this.
Yeah.
I feel personally CBDC is a fantastic tool to be because UPI is a systemic thing now. Now, as a disaster recovery or a BCP to UPI, I think this can be a really good play. And of course, the regulator is on record to say that cash usage should reduce with their usage. But it's still early days. I think we will need to work much more on this to take it up. We are working together on that.
So on the LCR norms, what is the feedback that's been given to the ITA?
So we have been giving, various feedback has been shared. Essentially, the regulator hasn't come back with the final guidelines. We will see how that goes. So, till the final guidelines come, it's too early to comment on that.
So you spoke about the Gen AI aspect inside. So what sort of an impact can it have on the bank's cost to income ratios going forward as well? There's a particular use case which you are working on.
Our use case is limited, but any technology is expected to bring down the cost to income ratio. So with Gen AI, with artificial intelligence, otherwise machine learning, all of that brings down the cost and helps us control risk. So in that sense, cost to income is always favorably linked because of Gen AI or any other technology.
What segments are you seeing immediate use cases in?
So use cases, as far as we are concerned, we are already using machine learning and artificial intelligence, not Gen AI. And those are largely in the business models, the risk models, the fraud risk models. There we are already using this. Gen AI we haven't started, we are working on this, but nothing live at the moment.